the motivations for buying gold and buying silver are often very different. The other thing I would say is I'm not certain why the ratio between gold and silver has any validity as an investment consideration. The fact that silver is 16 times more prevalent in the Earth's surface doesn't go to very much to their relative utility. Both have some utility as a monetary metal, but gold would seem to have deeper utility as a monetary metal. Both have some utility in commercial applications, but silver would seem to have more in commercial applications. Further, with regards to silver, the speculator needs to understand.
Rick Rule, a respected figure in natural resource investing, believes that market dynamics are shifting. He predicts that future manipulation in these markets will come from those betting on prices to rise rather than fall. This shift indicates a growing confidence in the value of precious metals, making them an attractive option for both individual and institutional investors. Institutions are already beginning to increase their holdings in precious metals, driven largely by central bank buying and notable price escalations. Gold, in particular, has seen significant momentum, becoming a legitimate topic of discussion among investment firms. This trend suggests a broader recognition of gold as a stable investment, especially in times of economic uncertainty. As gold prices rise, more institutions are likely to follow suit, further driving demand. Rick Rule emphasizes the different motivations behind investing in gold versus silver. Gold is often seen as a safe haven, a fear-driven investment that provides security during economic downturns. Silver, on the other hand, is more volatile and can be influenced by various factors, including industrial demand. Understanding these differences is crucial for investors looking to diversify their portfolios with precious metals. Despite common beliefs, Rule dismisses the idea of a long-term conspiracy to suppress silver prices, attributing its fluctuations to natural market forces. Now, we'll show you the best clips of the latest interview, but first, like, subscribe, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Manipulation occurs in all markets, and the manipulators generally try to profit on the difference in scope and scale between the physical market and the futures market. The futures market being much larger, much more leveraged, and very prone to outsized moves as a consequence of moves in the physical market. Therefore, if you're trying to profit on a down move in silver, you would build a ladder in the silver futures markets and then use a physical position, probably borrowed, to sell overnight during the period of time when the market is the least liquid to generate the most downward momentum in silver in the short term so that you could cover your futures positions as they reacted to what happens in the futures market. That exact same strategy happened in the decade of the 70s from a long point of view. The markets are manipulated in whatever direction the manipulators think will be easy to move. I wouldn't confuse yourself in the silver market by thinking that there was a 4-decade-long conspiracy to depress the price of silver. They didn't have to do that because the market did it. The US dollar was strong. You don't need to work really hard to cause something to decline that's going to decline of its own volition. I believe in 2022 that whole circumstance changed. And I believe at some point in the future that the short-term manipulation that happens in precious metals markets will be from the long, not the short side. And I don't think that there is as much overt manipulation of the formal media as people think there is. I think that perceptions are forged in a odd alliance of big thinkers, the World Economic Forum and all that kind of stuff. And I don't think that the leaders of government have to influence the media people too much because I think they went to the same schools and they hold the same value. Now, there are periods of time where governments can show favorites to media, but I would suggest to you that the whole emergence of social media has meant that there are sources of information and opinion that are disintermediated, that are much, much, much more difficult to manipulate. And that's one of the reasons why I am delighted with the proliferation of social media, irrespective of how much misinformation, disinformation, and impoliteness that takes place in social media. The fact is that I can get unvarnished access to opinion leaders, opinion shapers, and to popular opinion itself via social media that's one of the reasons why I'm so comforted by its emergence. When I look at popular media, broad media, even broad media that is allegedly geared to me, Dow Jones, Bloomberg, places like that, I'm struck by the centric and complacent nature, their bias. And obviously I'm more concerned about overtly state-controlled media, the CBC, the BBC, people like that. But I suspect, again, that there's much less of an overt control of the media, because I don't think they need to overtly control it. I think the values of most media journalists and the values of most defenders of big government are precisely the same. There's no need to manipulate it because it's already there.
In today's market recap, big silver rally of 2024 stalled. Why and for how long? The big silver rally stalled because speculators were unanimously long. The market does not reward consensus trades. The silver market will require less speculators before moving higher. Silver experienced a solid bull run in the period March to May 2024. Right before hitting silver's first bullish target of 34.70, the big silver rally 2024 stalled. Why? And for how long? Just to be clear, silver will hit $50 sooner or later. The question is when exactly. It's a matter of when, not if. Silver experienced an excessive number of speculators betting on the long side in the silver futures market. This, as said in our premium silver alerts since April, would prevent silver from moving much higher in the short to medium term. Speculators finally are giving up. Finally, they have been hit undoubtedly during those days with larger red candles. Remember, this is a futures market indicator. The leverage is insane when holding futures, so a 5% one-day decline has tremendous effects on a portfolio holding silver long futures. It's too early to get excited, but speculators leaving the arena is the prerequisite for silver to move higher. Lovely development, likely just the beginning. There will be a point in a few months where speculators will be hating silver, which is when we'll love it. Now we'll show you the best clips, but first, smash the subscribe button and turn on notifications. Enjoy the episode.
First of all, the silver buyer is more a greed buyer, a momentum buyer, focused on unbridled upside. The gold buyer is a fear buyer, a very, very different buyer. The second thing that, well, I think that's probably enough, actually. The motivations for buying gold and buying silver are often very different. The other thing I would say is I'm not certain why the ratio between gold and silver has any validity as an investment consideration. The fact that silver is 16 times more prevalent in the Earth's surface doesn't go to very much to their relative utility. Both have some utility as a monetary metal, but gold would seem to have deeper utility as a monetary metal. Both have some utility in commercial applications, but silver would seem to have more in commercial applications. Further, with regards to silver, the speculator needs to understand that to understand the future supply of silver, since so much of it is produced as an adjunct of the production of, say, copper, lead, and zinc, that you have no idea what the supply is going to be like 5 years from now. It'll depend on copper production, lead production, or zinc production. So I think that the equation is much more nuanced than the questioner presented. Extraordinary, and the more recent price escalation in U.S. dollar terms has created the momentum that has established gold as at least a legitimate topic of discussion among institutions. It's important to note that institutions' perceptions, like the perceptions of individual investors, has been formed, at least recently, over the last 40 years, in a market that's probably the most benign financial market in recorded history. The period 1982, after the breaking of the inflation of the 1970s, to 2022, world peace, globalization, the hegemony of the U.S. dollar, declining interest rates, I mean, a complete Goldilocks scenario. Nobody was afraid of anything. They didn't have any reason to be afraid of anything. Even in periodic moments of illiquidity, the 1987 debacle, the 2008 liquidity squeeze, the lesson that was learned was buy the dips. My suspicion is that epoch ended in 2022. Clearly, there is a hiatus in the process of world peace. Clearly, there's less globalization. Clearly, the demographics around the baby boomers coming of age is past us from an economic sense. And clearly, too, the period of declining interest rates is over. In addition to that, one thing that we don't notice is the fact that the growth of government, which we were able to afford over 40 years, is over. It doesn't mean the government won't keep growing, but our ability to afford it is coming to a screeching halt. So a combination of all those things, I think, will force institutions toward giving advice to the rest of the world. And that seems to be a particularly odd phenomenon. I've met a lot of financial journalists in my time from big news organizations. And while they struck me as being well-meaning people, they didn't strike me as being people that I would like to trust my money with. But the truth is that they do set the paradigm for many people. The institutional investor is different, but I need to say that the institutional investor is a person, and that person was schooled in the most benign economic climate known to man. The anticipation of the future is always set by the experience in the immediate past, and the experience in the immediate past was good. But let's think about an experienced portfolio manager. Let's just for fun say that Dunnigan Kaiser, as opposed to being a podcaster, is responsible for, let's say he runs the University of Florida endowment. And this money is coming in, and it needs to be sequestered in a way that will provide for the well-being of students of Florida 30 years from now. Now, for the last 40 years, he's invested in long bonds because that's been pretty sure and pretty steady. Now he has a circumstance with a portfolio of long bonds where if interest rate goes up, he gets screwed because the capitalized value of the distribution of the long bonds is worth less today. If interest rates and bond yields go down, he's screwed too, because the interest that he receives on those bonds won't be sufficient to compensate for the reduction in purchasing power that endowment will face 20 or 30 years from now. So his leading asset class, which is to say long bonds, the asset class which has made his reputation and saved the university, suddenly is challenged. Where is he going to go? Well, I suspect one place he's going to go, if he's any student of history at all, is an instrument that has fulfilled the function of portfolio insurance against inflation. I'm not suggesting, by the way, that Dunnigan Kaiser, Chancellor of the University of Florida, is going to jettison his entire long bond portfolio and put all the money into precious metals. What I am suggesting is that by rebalancing a little bit of his own portfolio or the University of Florida's portfolio, he's going to work profound change. And here's the statistic around that. The percentage of the market share of precious metals relative to other savings and investment asset classes in the United States is less than 0.5%. The 4-decade mean is 2%. If Dunnigan Kaiser, Chancellor of the University of Florida, reduces his bond portfolio by an eyelash and uses some portion of that eyelash to insure his bond portfolio, we will undergo a massive change in asset allocation in the United States. And that's precisely what I think is going to happen.
What do you think of Rick Rule's take? Do you agree with him? Will gold and silver rise further this year, or are we on the high of the year already? Post in the comments section your honest opinion and watch this video right here because you'll love it. I see you on the other side.